Okay, welcome students. Here we go. I've got a problem I want to work through. It's a chapter 11 problem. I like it because it covers some of chapter 7 as well. So there's a lot of material, a lot of topics that get covered in this one problem, right? It's a long, complicated problem, right? So it should be a little more complicated than something I would ask you to do on the exam. But all of the individual topics are definitely things that you should know. All right, this from the book. All right, so they embedded some golf references and jokes in here. I don't know enough golf to get them, so a lot of this goes over my head. All right, let's look here. Mr. Woods owns a WAR, a golf equipment manufacturer. He's hired you to compute his 2019 taxable income. Mr. Woods was able to provide you with the following information from prior tax returns. The taxable income numbers reflect the results from all of Mr. Woods' activities except for the items separately stated. You will need to consider how to handle the separately stated items for tax purposes. Also note the 2014 through 2018 numbers do not reflect capital loss carryovers. All right, so our first thing, it said, right, before we deal with all the other transactions, we know he has taxable income of $480,000. I'm going to make a note of that here. On January 1st, 2019, WAR purchased a plot of land for $100,000 with the intention of creating a driving range where patrons could test their new golf equipment. They never got around to building the driving range. Instead, they sold the land on October 1st, 2019 for $40,000. So we have to figure out what kind of asset this was. So what matters here is what their intent was, right? I mean, that's a little subjective, right? But as far as we know, they intended to use the land in their business, right? So it was a business asset. But they didn't use it for more than a year, so it's not a 1231 asset. It's just going to be an ordinary business asset. So whatever income from here or loss is going to be ordinary, right? Well, land doesn't depreciate, so their basis is 100,000. Amount realized is 40,000. So they're going to have a $60,000 ordinary loss from this plot of land, right, that they intended to use in their business, right? So that means it's not an investment, right? So it's not a capital loss. On August 17th, 2019, WAR sold its golf testing machine, Iron Byron, and replaced it with a new machine, Iron Tiger. I'm guessing there's some sort of golf joke in there, right? I know that's Tiger Woods. Iron Byron was purchased and installed for a total cost of $22,000 on February 5th, 2015. At the time of sale, the Iron Byron the machine had an adjusted tax basis of $4,000. The amount realized, right, the sale price was $25,000. All right, so I can look at something, right? So if I just say, right, amount realized, and minus adjusted basis of 4,000. I know we have a total gain of 21,000. Gain realized. Let me go a little bigger on here just in case. All right, so, but what I really care about here is, right, so this machine, right, was a depreciable asset used in the trader business for more than a year, right? So this is a 1231 asset. Because of this, the lesser of the gain or the amount of accumulated depreciation is going to be recaptured as ordinary income, right? Because their initial basis was 22,000 and their adjusted basis at the time of sale was 4,000. I know that there's 18,000 of accumulated depreciation. All right, that means 18,000 of this gain is just due to depreciation, making the basis smaller. Right, so that means I'm going to have $18,000 of ordinary income, right, because of Section 1245 recapture. Right, I have to match the depreciation deductions that were taken. The remainder of the gain is going to be $3,000 of 1231 gain. Right, I can see that here in the difference between the sale price and the original basis. Right, the actual increase in value of 3,000 will become a 1231 gain. Okay, next it tells me in October through December of the tax year, they sold various assets to come up with the funds necessary to invest in WAR's latest and greatest invention, 3-dimple golf ball. Probably another golf joke right there. All right, so these are their sales. They sold a black leather sofa used in the office, right? So this is going to be depreciable asset, used, and we can see it was used for more than a year, so this is a 1231 asset. Their initial basis is 3,000, and their selling price is 2,900. Because they sold it for less than their initial basis, I know any gain is going to be due to depreciation. Right? So on the sofa, right, their adjusted basis is going to be this minus this, 2,460. Right? So their gain is going to be 440. That's all due to depreciation making the basis smaller. So that's going to be all the ordinary income because of 1245 recapture. Right. That's going to be their amount realized minus their adjusted basis of 2,460. It's going to give me 440, right? And the lesser of accumulated depreciation or the realized gain, which is 440, is going to be recaptured as ordinary income. They also had an office chair, right? It's an office chair we're assuming used in the business for more than a year, right? More than 2 years in this case. Also a 1231 asset. Here, their initial basis is 8,000 and accumulated depreciation is 3,000. That means their adjusted basis was 5,000, but they sold it for 4,000, right? So 4,000 amount realized minus 5,000 adjusted basis means we have a $1,000 loss. It's a 1231 asset, so it's a 1231 losses. On 1231 losses, we don't have to do the Section 1245 recapture of depreciation. All right, they sold some securities. All right, these are all long-term. If we look at the dates, all of these are going to be long-term. They're all more than a year. The securities were bought for 12,000, sold for 20,000. So we're going to have $8,000 of long-term capital gain. All right, we're told these were all, I guess we're not told that, right? Marketable securities, we can assume are investment assets, right? These are always going to be capital assets unless you're some kind of securities dealer. Land held for investment, right? So it's going to be another investment asset or a capital asset. Held more than a year, so it's long-term. Bought for 45,000, sold for 48,000. We've got a $3,000 long-term capital gain. The other investment property, long-term, bought for 10,000, sold for 8,000. So that's going to be negative, right? A $2,000 long-term capital loss. All right, so right at this point, I'm just going through and I'm classifying the amount of gain or loss and the character of the gain or loss for each transaction. And then at the end, I'll combine them all together. Finally, on May 7th, 2019, WAR decided to sell the building where they tested their plutonium shaft lignite head drivers. WAR purchased the building on January 5th, 2006 for $190,000. All right. Oh, there's a lot happening on this one. I'm going to try to, all right. So they're saying for that initial purchase price, they allocated $170,000 to the building. So initial basis of $170,000 for the building and $20,000 for the land. So I'm going to have some land here. The initial basis for the land, $20,000. At the time of sale, the accumulated depreciation on the building was $50,000. Let me write that down. All right, so that I can tell that's going to make the adjusted basis of the building $120,000. The land, right, won't depreciate. Basis is always going to be $20,000. They sold the building. Sorry, for some reason I always yawn on these videos. It's long-term. They sold the building with the land for $300,000. The fair market value of the land at the time of sale was $45,000. So that much of the sale price we're going to allocate as the amount realized for the land. That means the rest of $255,000 will be for the building. All right, so I can see here the land is going to be, right, since there's no depreciation, these were depreciable assets or land used in the business for more than a year. So they're 1231 assets. Land is a pure 1231 asset because there's no depreciation. So all of this gain of $25,000, right, amount realized minus basis, is going to be 1231 gain. On the building, right, we had adjusted basis of 120. Sorry. So 255 minus 120. What's that, 135? Realized gain, right? Which that number doesn't matter a lot. What we really care about here, what I can see is, right, it was worth 100, their initial basis was 170, what they paid for it. They sold it for 255. That difference of 85,000, right? That's the real increase in value, not due to depreciation. That's going to be 1231 gain. The rest, right, the amount due to depreciation, which made the basis smaller and gave them a bigger gain, that 50,000, right? That's what we would recapture if it was personal property, but because it's a building, real estate, right? Just because Congress said so, is treated differently. So we don't recapture it. We call it unrecaptured 1250, right? Section 1250 is real estate, 1250 gain. Right, so we have these two types of gain. We've got this 1231 gain, right? These are all right, what they are. Okay, see if we have any more information. We're told that Mr. Woods in prior 5 years had the following net 1231 gains and losses. All right, so he had a net 1231 gain, a gain. In 2017, 2 years ago, he had a net 1231 loss. All right, so this one is easy because he hasn't had any subsequent gains, net gains until this year. This 6,000 has never been recaptured through look back, right? This is our other kind of recapture. We recapture gains on each asset, right, under 1245, right? The depreciation becomes ordinary. And then when we net everything, the net losses from the past, they get recaptured, right? Because they were ordinary losses in the past. We're going to have to turn them into ordinary income at some time in the future. So for right now, right, since I had, right, this is my only loss and there's been no gains after it, I just have an unrecaptured net 1231 loss of $6,000. We're also told he has a $5,000 long-term capital loss carry forward. All right, so the wording of the problem was kind of confusing. We're just told this doesn't not count, right? Already taking into account everything that's happened this year. He's starting with a $5,000 long-term capital loss carry forward. Okay. So we want to find his taxable income and his tax liability. So what I want to do next, I want to take all of my transaction information and I'm going to put it into, I made an Excel sheet, right? Or you could just write it on a paper. I want to put everything in the right category, right? So I have all my capital gains and losses, right? Going from highest to lowest. And then I put a column of long-term, and then short-term, I put a column for ordinary. And over here, I'm going to keep track of 1231 and 1250. So the 480,000, we were just told in the problem, he had that much ordinary income. The plot of land, we had a $60,000 ordinary loss. Microsoft is going to decide to change the format for me. Thanks, Microsoft. Appreciate it. The machine, we ended up with 18,000 of ordinary income and a $3,000 1231 gain, right? So I know that 1231 gains can be eventually treated as long-term capital gains. So it's tempting for me to put that 3,000 in my long-term capital gain column. But first, I'm going to just put it in a 1231 column because I have to net the 1231 gains and losses before I know how they're going to end up. Okay, the sofa was just all ordinary income, 440. The chair was a 1231 loss, so I'll put that in my 1231 column, right? Once again, the temptation would be, oh, I know 1231 losses are ordinary losses, right? Only if they're a net loss. Before I know the net, I have to put all the 1231 together and net it. My securities were an $8,000 long-term capital gain. My land was a my investment land, a $3,000 long-term capital gain. And my other investments gave me a $2,000 long-term capital loss. All right, we had the building that was a 1231 asset, right, used in the business. We had some 1231 gain. Again, I'll put that first in my 1231 column. And I had some unrecaptured 1250 gain. I'm going to put that right here. It's a little confusing. It's technically a 1231 gain, but it's also unrecaptured 1250. All right, so I want to keep track of it separately. We'll see why in a second. All right, the land, right, that the building was on gave me a $25,000 1231 gain. I had unrecaptured net 1231 losses. I can't forget that. And I had a long-term capital loss carry forward of 5,000. If you remember, a short-term carry forward will always start in the short-term column. A long-term carry forward will always start in this 28% column, right? Which is good for the taxpayer. We want it to start in the highest place possible. Okay. Now I think I have everything in one place. Now I can, the first thing I'll do is let me net my 1231 gains and losses. Should give me 112,000, right, plus my 50,000, 1250, right? If I had enough losses here, they could also reduce my 1250, but when I'm netting, I'm going to net these last, right? So they didn't get affected. I only had this one loss, right? So it comes out of my other 1231 gains here. All right, so that's my first, right? I've netted the 1231 gains and losses. Now I do the look back. I look back and I already know I've calculated I have these $6,000 of unrecaptured net 1231 losses from the prior 5 years. What I'm going to do, hopefully this is showing up well on your screen. I'm going to zoom in more. Apologies if that was kind of small. What I do with this 6,000 is I subtract it here. All right, and it gets recaptured and it becomes ordinary over here. So now I have, is that right? Did I add this? I think so, all right? Hopefully this is okay. Let me, oh, yep, I did it. All right, that doesn't feel right. Sorry, my bad. Okay. Remember I said us keeping track of this 1250, right, is gonna make sense, right, in a second, right, and I already forgot, right? This look back, take it out of here, is gonna come out if I have these unrecaptured 1250, right? This is arbitrary and confusing, but it comes out of the 1250 first before it comes out of any other 1231, right? So this is going to bring me down to 44,000 here. Does that make sense, right? If I didn't have any 1250, then I would do my look back recapture out of here. If I have 1250, then I do it first on those look backs, right? And so when I take it out of here and I make that 6,000 become ordinary, right? Because that means the unrecaptured losses means they got ordinary deductions in prior years. Now I have to match it with ordinary income. All right, so now I think I can. All right, so now that I've ended, I finally netted. Now that I have a net 1231 gain, that will become treated as a long-term capital gain. And my unrecaptured 1250, right, that's precisely, right, by definition, what goes in this category that's taxed up to 25%. All right, now I have everything. I can start my netting process of all of capital gains and losses. So first thing I can do is, I'm just going to delete this row. All right, I just want to net each category to have one number. 5,000 here, 44,000 here, 121,000 here, and I'm going to give up and use Excel. I'll get 444,440 here. Now I have one number I've netted within each category. Now I can net across categories. I'll always start on the long-term side, right? So this is, right, long-term on this side. I'll start on the highest category on the long-term side. I have a loss here, so I can move that loss to the next highest category, right? That means I'm gonna move it here. So this, right, has now been used up. It will become 0. This will become 39,000. This is unchanged. And this is unchanged. Oh, why would you do that? Okay. Okay. All right, so these, right, have already been moved and incorporated here, right? And here, right, in prior steps, right? So this is everything I have. I'm done netting. Now, right, my total tax liability, my taxable income will be this, plus this, plus this, right? But if I want to make his, figure out his tax liability, then it's helpful for me to leave them separated. So I'll always start with ordinary income. Let's see if I have the tax rates. Right, so the problem wasn't really clear, but Mr. Woods is a single taxpayer. I'm going to use the individual brackets, right? So he's going to be, right, with 444,440 of ordinary income, he's going to be in the second highest 35% bracket. All right, so I'll just use this formula. I've copied the formula here, right? So his tax liability is going to be his ordinary income minus the bottom of the threshold times 35%. I'm always overcautious about parentheses. I probably didn't need those. Plus, all right, the amount from the formula. Oh boy, what did I do? Oh, I have an extra dot there. Okay. All right, so my ordinary, all right, shoot me an email if you spotted a mistake here. My ordinary tax liability should be $130,747.50. Right, or you could round that up to 48. All right, so next, all right, I'm going to do, next I would look and I would see if I had income in these two categories, and I would see, right, if I was below 32%, right, if I was at 24% or below with my ordinary income, I would try to fit these in. Since I'm already above that in the 35% bracket, I know that these are going to be taxed at their maximum rate of 25 or 28, right? And so let's see, I can write that down, right, on my unrecaptured 1250. That's going to be the 39,000 times 25%, right? Because his ordinary income is high enough, they're going to get the maximum rate of 25%. Finally, I have the long-term capital gain of 121,000. Since my ordinary income, this is confusing, right? That's why I was babbling before, right? If my ordinary income was still in this 24% or below, then I would have tried to fit the 39,000 in before I calculated the long-term capital gains. All right, so technically, I'm actually doing that part last. All right, since my other gains are going to be at their maximum rate, what I can do is to try to get the lowest possible rate. In this case, it won't make a difference, but to try to get the lowest possible rate, now I'll do these long-term capital gains. Let me find those brackets, right here. He's single. And I'm going to look here based on his ordinary income. And since these over here are already taxed at the maximum rate, I won't count them, right? So I'm just going to start at 444,440, right? So all the income that's been taxed at his ordinary rates is what I use. All right, so that's going to already put him over the line here, and all of these will be taxed at 20%. That's going to be, all right, I'm going to have 121,000 times 20%. Yes. Okay. Right. So his total tax liability will be this plus this plus this. All right. So hopefully that mostly made sense. All right. Don't feel bad, right? If you, right, you were, all right, like you did this problem, you were mostly doing fine. You missed one or two things, so that made your later answers wrong, right? The main thing is that you understood each step, right? And after you've watched this, and I'll post the solution, then make sure that you could go back and do the problem on your own without looking, right? And that'd be a good test of your knowledge on chapter 11 and chapter 7.